AI is incredible. It can teach you how to fry an egg and even write a poem, pirate style. Yarr! But it knows nothing about your work. Slackbot is different. It doesn't just know the facts. It knows your schedule. It can turn a brainstorm into a brief. And it doesn't need to be taught. Because Slackbot isn't just another AI. It's AI that knows your work as well as you do. Visit slack.com/meet Slackbot to learn more.
Morning decisions. How about a creamy mocha frappuccino drink? Or a sweet vanilla? Smooth caramel maybe? Or a white chocolate mocha? Whichever you choose, delicious coffee awaits. Find Starbucks Frappuccino drinks wherever you buy your groceries.
Hello and welcome to episode 1058 of Fintech Insider News, brought to you by 11FS, the 5-time consultancy of the year that works with financial providers big and small to build the next generation of financial services. I'm Benjamin Ensor, Director of Research and Strategy at 11FS. To help me unpack the biggest and most interesting stories from fintech and financial services from the past week, I'm joined by a brilliant panel of 3 guests. First up, we have a welcome to the show for Lesia Kupriienko, Industry Lead of Finance at AppsFlyer. Welcome to the podcast. Please, can you let our listeners know a little bit about AppsFlyer and a little bit about your role there?
Sure. Thank you, Benjamin. Thank you for invitation. I'm Industry Lead for Finance at AppsFlyer. At AppsFlyer, we work with fintech companies on their key questions. Where are their best customers coming from and what makes them stay? So we are Marketing Cloud and we help businesses to understand their ad spend across different channels. And in my role, I work as an embedded consultant, helping fintech companies to understand user behavior and to make better decisions on where to invest for growth. Thank you for having me.
You're very welcome. And it's also a welcome back to the podcast for Maria Harris, Chair of the Open Property Data Association. It's really great to have you on the podcast. It's been a big few weeks for sort of open finance and open data more widely. Can you introduce yourself or remind our listeners of your role and what the Open Property Data Association does?
Yeah, it's amazing to be back, Benjamin. Thank you so much. Maria Harris, I am Chair of the Open Property Data Association, which we founded 3 years ago. Most of your listeners will probably remember me from mortgages. I've been in mortgages for 20 years, and I was part of the team who created Bank and had the absolute delight of creating the UK's first digital mortgage, and now working with the property and mortgage industry to do the same for the whole of the home buying process. So OPDA, Open Property Data Association, is an independent trade body. We're a trade association, and our members cover lots of the property, mortgage lending, mortgage intermediary and PropTech market, all working together to digitise the home buying process.
Amazing. Well, welcome back. Okay, well, we have a panel, so let's get started. So our first story is that Revolut is chasing a $200 billion US dollar valuation ahead of its initial public offering, or IPO. So Revolut is aiming to raise $200 billion as it eyes an IPO within the next couple of years, potentially making it more valuable than the combined market capitalizations of Barclays, Societe Generale, and Deutsche Bank. Revolut posted record results in 2025, with $2.3 billion in gross profit on $6 billion in revenue, and now operates 11 product lines, each of which generate over $1 million annually. Chief Executive Nick Stroronsky says a listing is 2 years away, framing it as a move to build trust, while also hinting at a US IPO, citing deeper liquidity and the firm's push for an American banking license. Now, this comes as UK regulators and the British Treasury meet fintech unicorns during UK Fintech Week amid mounting pressure to try and keep high-growth firms listing in London rather than New York. So let's start with the big picture. $200 billion is a big valuation. Lesia, is this a reflection of sort of Revolut's fundamentals catching up with its ambition? What do you think?
I would actually push back on the fundamentals are catching up, because I think the fundamentals were always there. What's changed in this story is a narrative. Revolut now has a UK banking license. As you mentioned, 11 product lines with each doing £100 million, and they are profitable. So this combination in general gives investors a story that they can tell with confidence. And $200 billion isn't really about today's performance. It's a bet on whether they can crack lending and the US. That's where the upside sits, but also where are the risks. And I think the end of this story and the valuation will heavily depend on this, on execution of the credit and what's going to happen in the US. So that's my opinion.
Yeah, I think that's a really great point, because you're right. If they can succeed in the United States, and there's some skepticism given that we've seen other European digital banks sort of struggling to get approval or win customers, that would make a huge difference and potentially really grow those revenues. Maria, what is Revolut now? I mean, it does many things. I mean, we know it's a bank now because it's finally got the UK banking license in addition to the European one that it had previously. But is it a bank? Is it a financial platform? I mean, it started as a FX, foreign exchange app, right? What do you think Revolut is, or does that not even matter? It's just whatever its customers want it to be.
Oh, I don't know. Well, there's definitely some morphing going on, isn't there? I remember talking about the first fintech unicorn and $1 billion valuation being breaking news, and now we're talking about 200 billion. Like, it's just the next kind of iteration of that. It's definitely a great example of something that started off as a tech play and to take cost out and make a process easier, and then apply that same thinking to disrupt lots of different bits of financial services. And you can say they're on a really clear trajectory now to, whether this becomes a kind of global super financial app that you can do lots of different things in and use it to kind of do your financial, almost like financial wallet, financial passport, whatever you want to call it, wherever you are in the world. So yeah, while the number's a bit big and a bit scary, I'm actually not surprised that that's the scale of the ambition, because there's a lot of the world's banking to be disrupted. Cracking Europe was great. Getting their UK banking license is a huge tick in the box. Next step, the US. But after that, I think if they can crack the US, then Asia, Africa, all up for grabs.
I think there's possibly some other digital banks elsewhere in the world that might have something to say about that. But yes, it's a huge opportunity. One of the things that really surprises me here, or seems surprising here, is that the valuation is greater than than Deutsche Bank, Barclays, Societe Generale, and so on, all put together. These are huge banks that, while they actually now have probably far fewer retail customers than Revolut, still have much bigger, business volumes, doing huge amounts of corporate banking and so on. So the amount of sort of revenue they're generating, the amount of business they're doing is still vastly greater than what Revolut is doing. But Lesia, you're sort of saying this is a future valuation, isn't it? It's that valuation is based on future revenue, future growth. It's kind of investors betting forward. Is that right?
Yeah, I do believe that it's kind of a bet, and it's also a bet on the conversion, I would say, because investors are not valuating by $200 billion just because Revolut is present in 40 or more countries, or they have 70 billion customers now. They actually betting on their capability to make revenue out of these customers. So it's a bet on conversion in this case. What do you think?
I think people want to have a slice of the action, don't they? I think investors are looking for growth stories. They're looking for exciting things. There's people who feel they've missed out on pick your favorite stock, but people who missed out on Tesla or missed out on Anthropic or whatever, and say, so I think there's sort of excitement in a way that just isn't about a Deutsche Bank or a Barclays. So I think it is very tempting to put a high valuation on that because you're trying to buy a piece of the future, and because we've seen other stocks shoot up, and so I think that does naturally attract investors.
It does feel like traditional bank valuations have been very suppressed for a long time, though. If you go back to kind of pre-global financial crisis and you look at bank book values, they were a lot higher than they even are now. So it does feel like valuations for kind of what you would have classed as your standard tier one, well-known banks is still very suppressed. I'd be interested to see if Revolut do IPO in 2 years, whether or not you see a halo effect on some of the incumbent banks and actually put some confidence back into the banking sector as a good investable market.
That's a really, really interesting point, isn't it? Because, of course, before the financial crisis, it turned out that some banks were actually sitting on a whole stack of dodgy debt, sitting on some very dubious mortgages and so on. Of course, we saw a number of them, like Northern Rock and so on, actually disappear. So actually, investors are sort of right to be a bit skeptical in the immediate aftermath of the global financial crisis. But yeah, I take your point that has that been overdone? Has the industry really learned the lessons from the global financial crisis, or are we starting to see sort of bad debt creep back in? I want to pick up on something else that Nick Stronsky apparently said about, going public was about sort of building trust. Maria, I'd be interested in your perspective on this. Do we think that customers necessarily even know whether companies are public or private and necessarily trust public companies more? Do you think there's something in that? Or is it maybe just as a little bit of a branding thing of, I could be a shareholder and, it's nice to sort of buy a little bit of a company that you do business with?
Yeah, I get perception's reality, isn't it? So, and you're saying before about creating that kind of excitement if there's an IPO and the opportunity for people to invest. So there's definitely some validation in there, isn't there? And some endorsement that if you do IPO and investors then invest that kind of money and value your company at that point, that there is public awareness around that, but it creates that kind of energy and public excitement that there's an opportunity to then be part of that and potentially grow with the company or to make some kind of asset gain out of it. So there's definitely some public awareness and visibility. I think there's a perception as well that if you are listed and publicly trading from a consumer perspective, that there's more transparency and that there's more accountability, and that for somehow, because you're a listed company, that you are more regulated, even if that's not actually true. I think the perception for most public is that is the case, and they would trust a public company where they can go and look you up and see how your price is changing every day and see what other people in the market are doing. So yeah, I think it's definitely, it creates an energy and creates an excitement, but it's a validation and a public endorsement. I think that you're a big company and big enough for investors to invest in you, and therefore you're safe.
The other really interesting question here is whether Revolut will list in London or list in New York if it does. I mean, it's interesting timing with the Treasury and the Financial Conduct Authority meeting fintech unicorns. But Revolut is still signalling that it may go to New York, which means that British retail investors would sort of largely lose out on the opportunity to sort of take part in an IPO. Lesia, do you think Revolut will go to the States? I mean, in some ways, it isn't really a British business. I mean, yes, it's headquartered in London, but the people who work there are from all across Europe. The customers are all across Europe. It's not really a British business necessarily, is it? So maybe there's no logic to listing in London. What do you think?
I think that actually Revolut is fundamentally a London story. And this actually matters from the founder's story including. And in my opinion, UK can compete on talent, on regulation and brand. But when it comes to capital markets depth, liquidity, the US wins. And that's not just the opinion, that's just the structure of the market. So with these talks, the honest question is, what is the UK actually competing here for? Are they trying to keep the company, or they want to keep the listing? Because this might require different things from regulators. And the Treasury meetings this week are the start, but the window is genuinely closing. We have a case of Wise that was listed publicly in London, in UK. And if Revolut announces a US IPO, it will be a significant moment for UK's credibility for a home for high growth fintechs.
Yeah, it's going to be a big swing moment, isn't it? It's definitely the sort of credibility and the depth of the UK capital markets is certainly being increasingly called into question. Okay, let's move on then to our next story, which is that Visa and TikTok are rolling out a creator card. So the two companies have launched a creator card and business account for UK content creators, which is designed to give faster access to earnings from TikTok Live and help creators manage their finances more like a business. The card allows creators to access income more quickly rather than waiting for payouts to settle, and separates business and personal finances, which is something 94% of creators say they want. This tackles a key issue in the creator economy: irregular and delayed income. Nearly half of creators report late or inconsistent payments, with many saying it affects their ability to operate or reinvest in their work. With an estimated 200 million creators globally, and the market projected to reach $500 billion by 2027, this move signals growing interest in building financial infrastructure specifically for creators as a distinct economic segment. So this is sort of being positioned by the two companies as one of the first sort of creator-specific debit cards. Maria, what do you think? Do you think creators are a specific group? I mean, people always talk about how, say freelancers often find it difficult to manage their finances. Are creators just really another sort of subcategory of freelancers, or are they more special than that?
It's a great place to start. I think I'm probably the wrong generation to be talking about this, but I think it's something different. I think it's something new and of itself. Creation always sat in different bits of industry, and now it's become a thing in its own right. And lots of people who started on TikTok did it as kind of side projects, or while either working in a gig economy or working full time and doing it because it was their passion. And now that it's become, really democratized, and it's a really good way to have control over finance and content and how you're seen to be out there. I think that the demand for financial services products to sit alongside that I think it'll generate its own industry. I think it's actually become an industry in its own right, and the pace that it's growing at, and the demand for the content to be so quickly turned over and so instantly created, there's definitely that need for kind of instancy and gratification. So why would you not want to be paid the same way and have access to funding that enables you to satisfy that demand, but also to satisfy your own needs? So I think this will become a job category in its own right.
It's interesting that you jumped straight to sort of thinking that creators are content creators, which of course, naturally, there are a lot of content creators on TikTok. But I was sort of thinking about, people who sort of create handicrafts, people who make sort of jewelry or knitwear, all sorts of stuff. I mean, it's just all the wonderful creative things that people do and sell. Lesia, do you have a side gig of your own? Do you have your own sort of business sideline? Do you have siblings or friends who do? I mean, what do you think of this story?
I think it's much wider. First of all, it's not only about creating something like a content and being a blogger. It's about their products that they trying to sell through the platform itself. This is one thing. On the personal note, I do not do that, but I do photography. And if I would think about myself posting something and then doing some live TikToks and then gathering these diamonds, that could be a potentially a way of income for me through our way, then it is important for me to have a possibility of the financial services supporting that. But also on the other hand, I think there is a bigger picture here about this whole process and what TikTok and Visa does. yeah, I can explore on that more if you want me.
Yeah. I mean, yeah. Tell us. What do you think?
So I think that when we talking about what TikTok is doing is something that banks were struggling with for a long time. They want to bring financial services directly into the platform where users already spent a lot of time. So creatives, they are not like actively looking for the business account. The product is coming to them inside the environment that is very familiar. They use it every day. And it's very different distribution models. And traditional banking has to spend marketing budgets and has to acquire users through different channels. While TikTok has already that attention, and now they are turning that into financial product. On the other hand, there was a study that said that Visa is actually trying to capture quite a big market, and by 2027, it's going to be like $500 billion. So if they will do that before any neobank or another player does it first, they are actually tapping into quite big audience, and it's not just creators.
Yeah, I agree with you. I think it's a huge audience. We do a lot of customer research at 11FS, and it's really interesting how often when you're talking to people, how many people have a sideline or a passion project and so on, and want to be doing something maybe different to what they do, want to set up their own businesses and so on. It varies from country to country around the world, but there are so many people around the world who do want to set up their own business, but just sort of feel that they need more support and more help. One of the things I'm really interested in is this point you're making about Visa, because actually what TikTok is doing here is maybe not so different from what, let's say, Grab has done in Southeast Asia or Uber, where you've got drivers or other sort of people who are using those platforms and sort of earning through those platforms, and then they're getting paid through those platforms. And to the point you're making, it's about sort of making it easier for them to get their earnings faster. But here, TikTok, instead of doing it itself, or ByteDance doing it itself, it's partnered with Visa, and that's quite an interesting thing, isn't it? Because Visa, of course, Maria, I don't know what you think about this, but Visa, of course, isn't a bank. It's a payments company, but it usually has sort of card issuers and other firms. So it's an interesting question. Like, well, who's kind of managing the customer relationship here? Is there? It's an interesting question. Like, how's this actually working?
Yeah, these have definitely moved more into the kind of becoming the rails space, haven't they? In the same way that payments used to rely on so many different third parties and different gateways to get through, and all of those gateways have been shortened as things have been digitised, and it's become easier to move that money around. So I guess if you were Visa, you'd be in a place where if you can make money instant, and digital cards are kind of, fairly ubiquitous now. Most of us pay with our phones and things rather than physical cards or physical money. Then, yeah, you could almost get to a point where that kind of finance stuff becomes really liquid. And actually what you're doing is giving the control back to the consumer, and that they control the flow of the money, and you're providing the gateway and a safe route for them to do that without them having to worry about connecting services together or worrying about sharing card details or bank details or connecting to third parties or anything else. You just make it really simple for them to connect to one place where you worry about all of the other stuff for them. I think it's a control. I think it gives the customer the control back.
Yeah. Do we think that we'll start seeing more and more services being added to sort of platforms like this? Because this is TikTok, but of course there's dozens, hundreds of platforms that people are using all around the world to create products, to sell products, and so on. Do we think we're going to see more things like insurance and credit and so on getting added to this over time?
Yeah, you can definitely see credit coming in, because that's kind of a natural evolution for it, isn't it? Especially for, like you say, people who are creating things that they sell, or where they're creating supply and demand chain. But you could also see it being used, to do like tokens, and you can have credits where you save, and rather than taking money out, you save your credits, and then you can use them for other things, and you can use them across platforms. And yeah, like I say, you can see the whole financial position of what you generate and what you spend becoming very liquid and very fluid, and not being so product specific, or not being put in specific buckets, as in this is money that I've earned, or this is a credit product, or this is a loan, or this is an overdraft, or this is my credit card spend. You can see it all kind of merging into one.
Certainly a super, super interesting story. So, congratulations to the teams at Visa and TikTok. It'll be very, very interesting to see how this evolves over the next couple of years. Okay, well, on that note, we will just take a quick pause here and we will be back very shortly.
Over 40,000 businesses across Europe trust Pleo to manage their spending. Now, platforms like yours can offer Pleo's capabilities, cards, spend controls, and real-time visibility directly to your SMB customers under your brand and integrated with your product. Pleo Embedded allows platforms to unlock a new revenue stream quickly without building from scratch. Solve your customers' biggest admin headaches, become indispensable, and earn every time they spend. Visit embedded.pleo.io to find out more.
As a chef, I know flavor doesn't begin in the kitchen. It begins on the land. And Westhome's nature-led Australian Wagyu is a story written in the landscape of Northern Australia. Cooking is storytelling, and Westhome Wagyu carries a story of Northern Australia itself, raw, powerful, and deeply authentic. It's a testament to the passion and care raised in the rhythm of Northern Australia. I'm Chef Maylin from 88 Club in Los Angeles, and I invite you to visit westhome.com/Maylin to learn more. And taste a story only Westhome nature-led Australian Wagyu can tell. That's westhome.com/MEILIN.
Okay, before we get back into the news, a quick heads up. Bite-sized, our weekly newsletter, now lands in your inbox every Friday. If you're after a 5-minute roundup of the biggest fintech stories of the week, it's got you covered. Then come back on Monday and tune into the podcast for the full analysis. You can subscribe to Bite-sized at 11fs.com/emails, or drop the link in the episode description too. Now back to the news. Our next story is that Lloyds Banking Group is proposing to cut waiting times with fully digital home buying service. Lloyds Banking Group has partnered with estate agency Connells and conveyancing firm LMS to launch a fully digital home buying service across England and Wales. The goal is to tackle one of the biggest pain points in financial services, the home buying process, which currently takes around 5 months on average in England and Wales, often longer. The new service aims to reduce delays by moving checks earlier in the process, digitising and sharing data between parties, and eliminating duplication. Using LMS's National Property Transaction Network, information like identity, property details, and sources of funds can be captured once and reused across the entire transaction. So let's start with the big picture. The home buying process is often described as slow and complex. It's complicated in any country, but England and Wales have a system that seems almost designed to make it a little bit more stressful for people who are going through what's already often one of the most important purchases they ever do in their life. Maria, this feels like an important moment. There's this huge opportunity to sort of try and modernize it, but it's really hard. How significant is this? How big is this?
It's absolutely enormous, and I'm hugely delighted that the story broke and has had the response that it had, and so happy that it's our OPDA members who have made it happen. There are other people involved in this who weren't mentioned in the headlines who are also OPDA members, including Credus, Armalytics, Novus, and also TM Group and Moverly, who were actually founding members of OPDA 3 years ago. So yeah, really delighted to see it happen. But this is actually 5 years into the journey to get us to this point. As you say, home buying is it's a horrendous customer experience. It's frequently ranked in the top 2, top 3 worst experiences that we ever go through. We're generally moving house in life.
total. Wow.
The only thing that ranks worse than home moving consistently is dealing with bereavement, which is just such a horrendous indictment on the industry. And the demand failure rate is just, it's heartbreaking. And you talk to anyone about, who's been through the buying or selling of a property, and everyone has a story to tell you, or knows somebody who's got a story, and they're rarely good stories. So there's a lot to fix. So let's say this journey actually started 5 years ago, and it started with the Home Buying Selling Council, which is a government industry collaboration group. And it was talking about how we give consumers better access to property data upfront at the start of the transaction. And that was material information, like how do you make sure that customers have got the information they need to make an informed buying decision. And that work was originally led by Trading Standards and now sits with the Competition Market Authority under existing consumer protection. So it was the first time really, I've been in, let's say, mortgages 20 years. When I joined the industry in 2005, we used to average 12 weeks to completion. And when the Home Buying Selling Council started in 2017, 2018, we'd gone up to 16 weeks, which we thought was horrendous. And now we're averaging 23 weeks. It's time that we made a real impact. But it's the first time I think I've seen in 20 years that I've been in the industry where we've had this level of industry and government collaboration on data standards and prioritising what property data should be digitised first and what impact that would have on the process. And for our firms who've been putting that into practice through various testings and pilots and beta, so the likes of LMS and Connells and Lloyds, who've done a great job leading that work, what it did is it evidenced the need for a kind of a much broader whole-scale transformation of the whole of the property market. And we're doing it for residential first, but actually it's applicable to commercial and land and buy-to-let and lots of other types of transactions. So the work started with how do we make sure that we have verified sources of data, the primary source of the data. So if you are getting your land registry title and deed, how do you verify that it came from them in a digital way rather than the current document with an actual wax stamp on it or a kind of stamped document? How do we create mechanisms where we can safely and securely access and share data between the parties? How do we create new models for consumer consent and for consent sharing between businesses and where liability sits? And then how do we deliver the technical and trust standards that we need across the whole of the ecosystem? And it's the first time where we've kind of had that collective thinking where we've recognised that we actually need one governance framework. And it's the first example I've seen where that framework covers lots of different regulators, where we need regulatory innovation, where we need policy change, and this is all underpinned by primary legislation. But it's the first kind of example of a data sharing scheme that covers multiple central government departments, every single local authority in England and Wales, and all of the different parts of the industry all coming together to collaborate on one thing. And at the same time, with an eye on how do we make sure we have interoperability with other smart data schemes, including open finance and open banking, and how do we achieve things like federation of trust frameworks, so that, it started off as something that sounded really simple and really straightforward, and it's morphed into a genuine transformation program, which is, in flight.
There's so much complexity in the process. Lesia, do you think international listeners, and indeed even Scottish listeners, are listening to this just thinking, how are England and Wales so far behind? Or do you think many countries actually have quite complex processes for transferring property from one person to another? And I realise it's a very broad and unfair question because I'm not expecting you to be familiar with the property market in every country. But do you think this is an area where England and Wales are just behind the rest of the world, or do you think actually this is quite a widespread problem in many countries?
I would say that it depends on the country globally, but it is a problem for UK, but for multiple countries, especially in emerging markets, this is not that big issue. So by tackling it, they almost repeat the framework that is already by default existing in other markets. That's first thing. So could be two angles, yes and no. On this side. But I also think that there is a very important part behind it, which is connected to the data itself, and the digital process is what's on surface, but the data is the most important part, and who owns that part that allows you to have no friction and less duplication and simplify the whole process and make it like more trusted for the users, more simpler. That ownership of who provides this data, who owns, is kind of like strategic one. I think maybe in this case, I will ask question to Maria. Do you think it's Lloyds or it's a platform provider behind it?
Yeah, so this is where the primary legislation actually comes in. So one of the things that we pushed really hard for when we realised how much infrastructure was needed to underpin this. And it's systemically important to the UK. And the UK housing market's complex for lots of reasons. We've got some of the oldest housing stock in the world. We have some very unique properties like grade 1, grade 2 listed, very unique construction builds, very unique, just like the way we do change. There's lots of things about how the UK trades property is very different to the rest of the world. Whether that's good or bad or indifferent. But the making the data available and making it accessible to consumers and giving the customer the ability to collect and share that data is the key driver in the legislation that was passed. So the legislation was passed last April, so it's been live for a year now. It's the Data Use and Access Act, and that underpins the ability for consumers to have the right to access their personal identity, finance, property, health, whatever data, and for them to be able to share that data in a safe and secure way with a third party of their choice, either to access better products or to have better services or to enable a transaction like home moving. And that's where you still need industry to come together and actually make that happen, and to put the trust mechanisms in place and work out how do you digitally verify the transaction parties who are in there. How do you validate that data came from its authenticated source? How do you prove the provenance of that data and that it hasn't been tampered with between leaving the registry, passing through the digital property pack, the estate agent, the conveyancer, and into someone like Lloyds? How do you make sure that data is reliable all of the way through? And property is such a high-risk transaction and a high-value transaction, so those mechanisms have to be absolutely the highest standard that we need to keep everyone safe, which is why it's such an important smart data use case, because we solve the complexity for housing and for something that's as high risk and as emotive as property, and it makes the other smart data schemes much easier to deliver because we'll have broken a lot of the solutions, a lot of the problems that need to be fixed for this to work.
Do you think we'll see other firms following Lloyds quickly, or do you think other firms are going to sort of wait and see whether Lloyds is able to deliver a much better customer experience or lower the costs and so on? How quickly do you think other firms might join in, get involved?
So digital property packs and the sharing of this data has actually been live for about 2 years, and there are lots of firms who are doing it. I think the LBG Connells LMS is the first example where they've joined together the whole chain, including the identity, the risk and fraud, the anti-money laundering, and all of the other checks all of the way through. But yes, so sellers creating their digital property pack up front, sharing that data with their estate agent, instructing their conveyancer up front, which is actually a behavioural change rather than a technical or a data change. But even just having a seller instruct their conveyancer and have their digital property pack up front has a huge impact on how effective their transaction is and on the success rate of their completion. And we have, lots of our firms and all of our OPDA members join us committing to implementing those standards and adopting this way of working. So yes, we do have other lenders who are actively involved in different stages of implementation. But like I said, there's a lot of this is underpinned by primary legislation. But we also have the smart data strategy and the industrial strategy, which were published last June, talking about the future of smart data being the cornerstone of economic growth, and the first smart data use cases being delivered by 2030, of which property is one. So this is going to become kind of normalised for everyone. We definitely have a deadline to hit and a clock that is ticking for us to get this live across the board.
Fantastic. Well, let's hope this reduces the stress levels for home buyers across England and Wales and continues to do so. All right, let's move on to our final main story this week, which is that NatWest Group is planning to expand the scope of financial education into UK workplaces. So NatWest is expanding its financial foundations programme with a new focus on investing, aiming to help address the UK's long-standing financial confidence gap. The bank plans to reach 50,000 people in 2026, delivering free workshops in workplaces, charities and community groups, supported by 300 newly trained facilitators. The new sessions are designed to demystify investing, building on existing workshops covering budgeting, saving and financial planning. This comes as 58% of UK adults say they'd attend financial education sessions if offered at work, and as policymakers push to close the UK's advice gap and improve access to financial guidance. Lesia, what do you think of this? Do you think that financial education in the workplace is a way forward? Do you think that creates an opportunity for sort of adults to learn and understand how to make better decisions, or not?
Yeah, first of all, I think it does create an opportunity for people to learn more. And there is a younger generation that actually kind of has an expectation from their employer to provide this type of education, to provide the tools and invite companies to support that journey. And for NatWest is actually moving to the customer earlier in their journey before even they think about choosing the banking product. They're doing something like B2B to C model, where they work with employers to get and to reach employees. This helps them build relationship first, and they do this educational process first, not just selling the product as or stay with me for the salary, etc. So I think it is a smart strategy. It does help society in general, but we have to be conscious that these types of moves by big banks, they also have a strategy behind that is related to the customer journey, in my opinion.
Yeah, because I saw this and I was a little bit skeptical. I mean, I applaud the intention, but I wonder about, 50,000 people sounds like a lot, but in a country of 50 million plus adults, it's sort of a drop in the ocean. I mean, Maria, what do you think? Am I being unfair? I mean, it's great, but it's 50,000 people in a country of 50 million. It's not really going to move the needle, is it?
I would agree with that. I absolutely applaud the intention, and I think using employees to do it is really smart. It makes it human, it makes it approachable. It's back to the what we're talking about Revolut and who people trust, to give them that kind of education, advice, guidance. So I think absolutely it's the right thing to do. But the financial literacy of the UK and the lack of financial education for most people right up past university age, we know has been a challenge for such a long time. And 50,000 people is better than no people, but I would like to see something that's on a much broader scale. And I think we are seeing it in pockets. We've seen other financial organisations, community and building society banks doing kind of local initiatives and like digital training and lots of other things. But I think we need something much bigger if we're going to get the UK collectively into a place where they are confident managing their money and confidently knowing what they're doing when they're investing. I think there's a responsibility there to make that happen.
Lesia, you said something really interesting a moment ago, because you said, there's a sort of younger generation maybe has an expectation that their employers will give them more sort of financial education and just help them with some of the basics. Do you think that same generation wants in-person advice and training, or would that be digital? Or, is there something Is there something clever NatWest could do here? I don't know. I mean, it's an interesting question, isn't it? Should this kind of education be in person? Does that make you more likely to turn up? Or actually, is it just easier if it's digital? Or is the problem the digital is just nobody ever watches it because it's just less interesting than everything else that's on TikTok?
Yeah, exactly. Or another item I need to watch during my work day, which I'm not necessarily going to do. I do agree that this approach adds what Maria said, like a human touch. And it's a very important thing to have. And a lot of employers, when they hire similar or collaborate with the companies on their similar social initiatives, they do tend to do that in person, and that makes sense for NatWest to do that in person, but they might as well also do some kind of a digital course or product that will increase whatever they want as an end goal, education of generations in a much higher impact, if that makes sense. Because they can cover much more people that will, if they want to have this education in place, attend or view that. But there are like different sides of this coin. And yeah.
Maria, what do you think that human touch is maybe the missing, the sort of the key to this, the missing component? Because there is more and more information available, right? There's more information available now than ever at any point in the past. Does a human give you that kind of nudge, or that confidence maybe to just, if somebody, or that reassurance?
I think mortgages is a great example of that, isn't it? Because you can go and do your own research on mortgages, but it's complicated and you don't want to get it wrong. And there are lots of questions that feel really stupid that you don't want to ask. And sometimes it's easier to do that with a human and go, I really don't understand this. Can you talk me through it? And we used to have, I have to sort of make myself feel really old here, but we used to have financial advisors who used to come into the workplace, and pension advisors. And, you would get the chance to go and sit one-to-one, and you didn't feel like you were asking daft questions then because you were in a safe environment. So yes, I think there's a human need for reassurance. And I think the mortgage journey kind of evidences that, where people go and do lots of research, they go and find their products, they can go and do a bit, but they'll still go and speak to a human mortgage advisor and go, can you take me through the process? Can you check that I'm doing the right thing? Can you give me the advice? So yeah, I think the safety blanket is a good thing. I think that's a very human emotion to have.
I'm tempted to suggest that ChatGPT is there for the daft questions, but I think your point is exactly right, though, about the reassurance of, am I doing the right thing? That is more likely to come for many people from a human, perhaps, than from an AI. Okay, we will take another quick pause here and be back very shortly.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Okay, now for a quick look at a story we don't have time to cover in full, which is that Hello Clever is partnering with Checkout.com for a global payments push. Hello Clever has partnered to support its international expansion with Checkout.com as Hello Clever looks to scale its AI-driven payments and rewards platform globally. The company combines real-time payments, embedded loyalty, and AI, positioning payments infrastructure not just as a utility, but as a growth driver for merchants. Already live with Checkout.com in Australia, Hello Clever is now aiming to expand into more markets, including the United States, using Checkout.com's global acquiring network, tokenization, and authentication capabilities to scale. At the core of its proposition is a buy-to-earn model, offering real-time cashback at checkout, turning transactions into immediate rewards, and in theory, deeper customer engagement. So really interesting spin on the sort of payment service provider model here, as Hello Clever tries to combine that sort of payments acceptance with loyalty and rewards to try and help merchants do more than just take payments from customers, but actually build relationships and loyalty. And if you're going to scale that globally, it does make sense to partner with a business like Checkout.com that's already built a lot of that payments infrastructure. We had a quick conversation with Monique Biadi, head of commercial at Checkout.com, who shared her thoughts with us about this partnership.
What really stood out is how Hello Clever is rethinking the role of payments. They aren't just processing transactions, they're turning them into a moment of engagement. So by combining payments and AI-driven rewards, they're helping merchants transition payments from a cost center to a genuine loyalty driver. And this aligns perfectly with our mission at Checkout.com. We've always believed that payments should be seen as a strategic advantage, not just a commodity or, basic infrastructure. Partnering with a visionary fintech like Hello Clever allows us to demonstrate how Checkout.com's high-performance rails can power the next generation of consumer experiences. International scale is where Checkout.com's global footprint and deep local expertise really come into play. Expanding across borders, look, it's undoubtedly complex, but our platform simplifies this, providing the licensing coverage and the flexible technology that Hello Clever needs to enter new markets at speed. We're providing more than just the baseline processing. We're layering in our proprietary authentication and fraud detection to ensure Hello Clever can maintain high authorization rates as they grow. Ultimately, I think it's about giving them that local expertise at global scale, as well as the hands-on performance optimization required to scale a relatively sophisticated model across very different regulatory landscapes. The buy-to-earn model, it's a game changer because it eliminates that lag between the transaction and the delivery of the value. So by embedding the rewards directly into the payment flow, merchants can drive immediate conversion and much higher customer retention. It's quite a powerful shift from more of a passive loyalty to really active and immediate engagement. And we think that's where the industry is heading. So at Checkout, we're really proud to provide the underlying technology that handles the complexity of these payment flows.
And finally, I don't know how into Korean cinema you are, but this next story feels like the plot of a Korean thriller, complete with a heist and a twist. So this is that the Korean police have been tracking down a second thief following the first suspect surrendering after a crypto leak. So the South Korean police are now chasing down a second thief after a rather unfortunate incident involving the country's national tax service. Officials had seized around $4.8 million worth of crypto assets, but accidentally published the mnemonic code, essentially the master password, to the wallet. Unsurprisingly, the funds were quickly stolen. Even more surprisingly, the first thief then returned the funds and confessed. But then the assets got stolen again. Police have since arrested the first individual and are now searching for the second, while also tightening their own processes around handling seized crypto assets. So, Marie, how on earth does a government agency accidentally publish the master key to a crypto wallet?
It's very enterprising and lots of lessons learned, I'm sure.
It's a wonderful story, isn't it? And Lesia, the first thief returns the money. I mean, I don't want to put you on the spot, but if you'd stolen 4.8 million, would you return it? It's amazing, isn't it? That and then someone steals it again. I mean, is there someone at fault here? I mean, is it the second thief? Is it, the wallet's still accessible? I mean, it's like, is crypto is just too complicated for tax authorities? I mean, what do we think's going on here?
It seems like it's a process failure than anything else. And we all know that technology behind crypto, everything is secure. And there are some internal controls that could be weak. And there's always human in the loop. So mistakes can happen. And it shows just a lack of proper awareness and handling the situation, I think. I'm not sure if I would be a thief that returns that money, but probably yes, because you can easily track me to that money. So, yeah, it's a fascinating story.
I love your point about the human error, isn't it? Because that's so often the case, isn't it? We design all these sort of compliance systems and all these processes and so on, and they assume that sort of human beings are sort of rational and have perfect memories and so on. And of course, we're anything but.
Sorry, but also think about the situation that the first thief got access to the key and stole money. Why didn't they do anything for the second one? This is also another question that I have in my head.
Yeah, because they've returned the money and then they've not sort of secured it, or
Exactly. Yeah.
Maria, can you think of any sort of equivalent? I mean, what in sort of more traditional finance, what's this like? Can we think of? I mean, this is basically leaving the door to the bank vault open, isn't it?
Yeah, I was going to say that it's like stealing the crown jewels and then putting them back before MD had noticed they were missing, or stealing some really clever art from the Louvre and putting something fake in and nobody noticing. It's I mean, ingenious, but I'm with Lesia. I'm like, when the first thing happened and the first amount of money was stolen, like, who noticed and why didn't they do anything about it? And or did they not realise until the money was returned and then were too slow to take it down the second time? I think, humans are fallible, and I'm sure there will be a human element in this story somewhere where it all unfolds.
I do hope the first thief gets forgiven for having done the right thing. Okay, well, thank you so much to the two of you for joining me today. This has been a fantastic conversation. Where can people find out a little bit more about you and your companies? Lesia, where can people find out more about you?
I am on LinkedIn. My name is probably going to be somewhere in the posts, and AppsFlyer.com is our website where you can find out information about the company itself.
Fantastic. Maria, where can people find out more about you?
Yes, please do follow us on LinkedIn, Open Property Data Association. Follow our page. And if you head over to our website, you will be able to download a free copy of our consumer survey and find out what customers really think of the home buying process and the digitisation of it. And you'll also find information on our sandbox, which is an open invitation to everyone in the property and mortgage industry. Come and play with smart property data.
Thank you. As for me, Benjamin Ensor, you can find me on LinkedIn. And that wraps up today's episode. Thank you so much for listening to today's show. If you've liked what you've heard, please do follow us on your favourite podcast platform of choice and do recommend us to your friends and colleagues. Thank you all so much again, and goodbye.
Hey, Mama. Thanks for making all my favorite recipes.
Hi, Ma. Thanks for your unfiltered advice.
Hi, Mom. Thanks for always being by the phone.
Hey, Mom. Happy Mother's Day.
When you ship UPS Air at the UPS Store, your items arrive on time or your money back. Guaranteed at no extra cost. Exclusively at the UPS Store U.S. retail locations. Visit the upsstore.com/airshipping for full details. Terms and conditions apply. Send your Mother's Day gifts at the UPS Store and we'll get your gratitude there on time.
Putting off replacing your window treatments because you think it's complicated? At Blinds.com, we've spent 30 years proving it doesn't have to be. And today is your last chance to save big on Spring Black Friday deals. Whether you want to DIY it or have a pro to handle everything from measure to install, we've got you. Free samples, real design experts, and zero pressure. Just help when you need it. Shop up to 45% off with minimum purchase, plus get a free professional measure during the Blinds.com Spring Black Friday Last Chance sale. Rules and restrictions apply.